Hello, everyone. Welcome to the Sustainability Story, a podcast where we explore the intersection of all things sustainable with the investment industry and the global financial system. My name is Deborah Kidd, and I'm your host for today's episode. My guest today is Dr. Livio Stracca. Dr. Stracca joins us to talk about the launch of a unique tool in climate risk management, the first publicly available short-term climate risk scenarios, released in May by the Network for Greening the Financial System. This new tool helps regulators and financial firms understand how climate policies, extreme weather events, and economic shocks could disrupt financial systems, not decades from now, but within business and policy planning horizons. Dr. Stracca is the Deputy Director General for Financial Stability at the European Central Bank. His career at the ECB spans more than 2 decades. He has published extensively on macroeconomics, international economics, and international finance. Dr. Stracca holds a PhD in economics from the University of Leicester, a law degree from King's College London, and he holds a degree in statistics. Dr. Stracca also chairs the Network for Greening the Financial System workstream on scenario design and analysis. And in this role, he leads global efforts to develop climate scenarios for regulators, financial institutions, and supervisors. Today, we're going to talk about Dr. Stracca's work with NGFS. And for our listeners who may not be familiar with the organization, NGFS is a global coalition of central banks and financial supervisors who develop best practices and tools to strengthen the financial system's response to climate and environmental risks. So, welcome, Livio. I'm delighted that you are able to join us today.
Thanks for inviting me. I'm glad to be here.
Before we talk about the short-term climate scenarios, I want to ask, I'd love to hear about your sustainability story and what led you to your work at NGFS.
That's a good question. So I would say I stumbled on sustainability in the sense that I was working on mostly on other issues, and when I moved department a couple of years ago within the ECB, I was asked. At the time, the ECB had been asked to chair the scenario workstream of the NGFS. Essentially, the choice fell on me. I guess partly was also due to the fact that I have a background in macro modeling as well, and that is important for climate as well. But I would say most of it was by chance. And to be honest, also I not really worked on climate and sustainability before. I mean, I was certainly curious about the topic, but I not seriously worked on it. So I had to catch up a lot at the beginning. I had to learn a lot of new vocabulary, new concepts. So it was a steep learning curve at the beginning. But I think now, after I would say 3 years working on climate, I feel I'm really into it now. That is a bit my journey. So I write a bit out by chance, but then I really invested on it, and now I enjoy and I attach a lot of importance to this strata work.
Yeah, you mentioned your work in macro modeling, and for those who haven't seen the short-term scenarios, the modeling and the development of those it's quite intricate. Those are very complex models. And I want to talk a little bit more about that later. But right now I wanted to dive into kind of what led to the development of the short-term scenarios. I know NGFS has developed long-term climate risk scenarios, and those have been around for several years, and they're periodically updated. But the short-term scenarios are new, and you've said that nobody else in the world has a tool like this. So can you talk a little bit about that and why NGFS decided to launch these short-term scenarios?
Yeah. So I mean, I agree with what you said essentially. So traditionally, not only the NGFS but also other entities, for example, the IPCC had developed long-term scenarios. But I think that over time, it became clear that that in our world, which is the economic and financial world, decisions are taken based on a much shorter horizon. And that's also, by the way, the world of politics. So all the decisions that are important for our authorities, because the NGFS essentially is a club of supervisory regulatory authorities and central banks. So these are entities that take decisions, within an horizon of 5 years or a few years, I would say. So it became quite natural to want to shorten the horizon of these scenarios, but partly also this was also an outside request. So at some point we did a survey of users. So asking the question is, what do you would like to see in the NGFS scenarios? And I think the second most mentioned kind of need was this the short-term scenarios. So I think came both from within, but also from outside pressure.
Well, let's talk about the scenarios themselves. There are four that have been released under this framework. And could you tell us a little bit about each of those four?
Sure. So first of all, the process was organizing two separate steps. So we first had a bit of thinking of what are kind of plausible but they scenarios that we could have, and so the NGFS released a conceptual note, and in this conceptual note we had actually five scenarios. There was also a process of feedback, consultation. But then after these scenarios were broadly seen as meaningful, we then launched a procurement for actual modeling of those. A consortium of modelers won this procurement, and then we worked together to produce these short-term scenarios, and we have released four of them. So the fifth one, might be released later. So we are a bit behind on the fifth one, but the four have been published. So two of them are related to transition risk, and two of them more on the physical risk side. And here the idea is, of course, what you could envisage all kinds of different scenarios. So there is an infinite amount of scenarios you can think about. So our point was, let's do something that it looks like meaningful and as a clear narrative, and so it can be taken as useful starting point. So it's something that is rather obvious to do. So in the error transition risk, the two transition scenarios essentially assume that countries, rather than following the currently planned climate policies, they rather converge to the net zero path. So let's say we said, okay, assume that countries, rather than falling short of the Paris targets, they actually implement policies that go there, and that, if you think about this, is an obvious scenario to think about. And so the two transition scenarios differ by the way this is done. So in the first one, which we call Highway to Paris, this is done in a orderly way and also efficient. While in the second one, we assume that, so the process is still convergence towards the net zero path, but is more disorderly, happens abruptly in the middle of the horizon, and also it is done less efficiently. So the carbon tax that implements this transition is more distortionary in the second scenario. So it's both more abrupt and a lower quality transition. And so this is what we call a sudden wake up call, because there is this element of surprise in the middle of the horizon. And then on the physical risk side, we mostly took the historical distribution of physical risk damages for each region, and we just took a tail of that distribution. So in particular, we said, okay, assume that we have a 1 in 50 years manifestation of the distribution. So something that has a 2%, more or less, a 2% probability of materializing. And let's see, based on the historical data, what kind of effect, this could have on the economy. So these are the two physical risk scenarios, are related to that. And the difference with these two is that one is a purely physical risk, The second one is also an interaction between transition and physical risk, in the sense that we assume that climate events, very, very, very negative, very bad climate events, also put kind of or create a friction, or if you want, or say make it more difficult for emerging economies in particular to export raw materials. So and the raw materials that are critical for the green transition are used by advanced economies. So in this way, basically, climate events in emerging economies made the transition more costly in advanced economies. That is the fourth scenario, which is called divergent realities.
So the scenario results are quite specific to geography and macroeconomic indicators and industry. And I want to help our listeners understand what types of outcomes or results will see from using these scenarios. For example, know that the disaster scenario shows up to a 12.5% in GDP losses in Africa, with the effects not just contained in Africa, but rippling through the global economy. What were some of the other notable results that you saw in the scenarios?
No, thanks. So I would say the physical risk scenarios all have rather large effects. You mentioned the 12% for Africa, but you also have a 5% for Europe. And all other main regions have similarly large effects. I mean, Asia is even larger. I think it's 7%, if I remember correctly. In general, the physical risk side, at least I was surprised on the upside. So the effects are large, and probably larger than what most people expect. Is not only, I guess, the intensity that depends on the geography, also the nature. So some events are we call it wet events. Think of floods. So these are hit more some geographies. For example, East Asia. Then you have dry events like droughts or heat waves hit more Africa, and so on. So it's about the quantity and the quality of the effects that is different and geography dependent. If you think about the impact on inflation, which is also a variable we look at. So because many of us are central banks, so we naturally look at inflation, interest rates. So we find that the impact on inflation is rather kind of muted for the physical risk scenarios, but is actually larger for the transition risk. So the transition risk scenario is, you can think of those as abrupt shifts in carbon prices, so affecting the cost of energy in the short term, and thereby inflation. So you have like larger inflation spikes, following the transition scenarios, and these also prompt some reaction from central banks, and so you have a rise in interest rates, and so on. So what users can find in these short-term scenarios, which by the way are very easily accessible. Okay, even a person with low IT skills like myself, could easily download the data. So what user will find is essentially is a set of macro variables for their jurisdiction. Again, easily downloadable, plus also a number of financial variables. So the scenario also contain variables such as probability of default, equity prices, interest rates, risk premia. So there is also a financial module that creates these financial variables. So a user can can look at these financially real variables, and important to note, for many cities we also have sectoral variables. So you can look at agriculture, or you can look at say the energy production, divided into coal or renewables, and so on. So there is quite a degree of sectoral disaggregation.
So there is a base case scenario for each country and region, and then a user would run the scenarios relative to that base case scenario and see how things change over the next 5 years, depending on which scenario that they run. So is that how it works?
Yes. So we are often asked also about the probability of various scenarios happening and so on. And I guess the best way to think about this is is to say that the baseline is probably the best possible estimate of current and future climate policies. I mean, unfortunately, it's not updated because it takes time to produce this scenario. So this part has been updated to the end of 2023. So is a little bit outdated now, but this is what we have. So the users can think of the baseline, as the name says, the base case. So the most likely path, if you want, to climate policy, or at least the path that countries are committed to. So and that is kind of the benchmark. And then you can think of the short-term scenarios. There are kind of perturbations around this most likely path that has some kind of stress or tail nature. So these are not things that are most likely to happen, but it's more like a tail event that is useful to think about for in case you want to run a stress test, for example. So you want to see, okay, on the physical side is approximately 2% probability event. How well am I prepared for this? So this is what the short-term scenarios also tell you. But some users, we want to actually to use a baseline, because the baseline is again the base scenario. So it will depend on the use of these scenarios by different users.
And so, how might a central bank use these scenarios to adjust its monetary or fiscal policy?
But monetary fiscal policy they are also part of the scenario. So they are all endogenous.
Okay.
So as I said before, for example, in the transition risk, you have inflation going up, and you also have central banks reacting to that and increase interest rates. So it's all part of the model of the transmission channel. Yeah. So this is probably my first kind of pass on this.
And for financial institutions like investment firms or maybe insurance companies, would a use of this tool be something like an investor is perhaps looking to buy real estate, looking globally? And could they use these short term scenarios, physical risk scenarios, possibly to evaluate the kinds of geographic risk that might affect properties that they are considering?
So let me say first that with the release of these scenarios, we aim to have some rigorous approach that puts some discipline in these kinds of exercises. But it will not, it's not going to be for most of these exercises. It's not going to be usable one by one. So some adaptations, will be needed. And so you mentioned, for example, residential or real estate, real estate prices. So, for example, this part, for example, is not very well developed in the scenario. So one would need an additional step, complement some variables. Yeah. So there's so not all variables that are conceivable are released in the short-term scenarios. And also, users may need to adapt to different baseline, for example. So as I said, the baseline is for many countries rather outdated, but this also can be adjusted. So users can also shift the baseline and can consider the scenarios as deviations from the baseline. So it's a deviation from a different baseline. So if GDP, say, is 5% below the baseline, but the baseline is different, then the users can compute the GDP, which is, the new baseline minus 5%. So just to make a concrete example. So is a tool that is quite adaptable, and we would expect the users make some adjustments, but hopefully the short-term scenarios go kind of 80-90% of the way towards having a coherent scenario for each particular exercise. So it's something that is adaptable, but the core hopefully makes sense, as it should be preserved.
Thank you. That's helpful. So on your website, you have the data that users can download, and then they can make the adjustments to that data and run a revised scenario.
So running a revised scenario entirely, is not going to be easy because it's not going to be possible, without having the whole modeling suite that we have. So running the short-term scenario takes months of work, and it also includes, by the way, a very strong review process. So we ask members to check the results for their jurisdictions. So everything has been thoroughly checked by each member. The NGFS is a member-led organization, so we have the climate scenario work stream has 200 members, and members are in the first line to check the results. So this just to say that producing new scenarios globally is a very heavy exercise, and so the users are not going to be able to replicate the whole modeling suite and hold the results, but what they can do is to make some basic adjustments. So just to make a concrete example, so suppose that you are a financial institution, you are interested in a particular sector that is not covered by the short-term scenarios. You might want, for example, to take the largest sector that is covered in the scenarios, or even kind of GDP, and try to map, so to make an auxiliary regression between your target sector and GDP, or your target sector and the sector that is included in the short-term scenarios, and see, given what is in the short-term scenarios, what the sector you are particularly interested in would do under this scenario. So I hope it's clear. So suppose that, for example, you are in the steel industry, and suppose the steel is not covered by the short-term scenarios, but the steel is, say, more volatile in the GDP. That this means that if GDP, say, goes up by 5% or down, say, 5%, then the steel industry will go down by more than 5%, and so on. So we would expect users to run some kind of auxiliary analysis, but keeping the overall structure of the short-term scenario unchanged, because the user will not be able to run the scenarios in totality. Is that clear?
Yes, and thank you for clarifying that. The work that's gone into the scenarios is really quite amazing. It's complex and the inputs are extensive, but I do recall your point that anyone, even with limited technical skills, can run and use these scenarios. I know your long-term scenarios are updated periodically, and I wondered how you envision seeing this tool evolving over time.
Thanks for the question. So the long-term scenarios, indeed, we plan to update them every 2 years. We are considering updating them now, so for next year. Also, because this year there's going to be an important update of the country's climate policies, the so-called national determined contributions in the Paris process. I mean, you may be more familiar than I am on this. So we have this planned update, and we strive continuously to improve them. I mean, we receive a lot of feedback from users also on the long-term scenarios. We know that many users are worried about tipping points or linearities. That we are kind of maybe underestimating some risks. We have an excellent team of climate scientists working with us on these long-term scenarios. So I'm quite confident that they are reflecting the current science. But of course, science evolves, and we need to be up to date. But just to also be clear with the users who sometimes criticize certain choices, is sometimes it's not that we don't want to change models or scenarios, but sometimes the science is still developing. It's the science itself that is moving, and science, good science is always slow, so cannot rush science. So for example, in the area of tipping points, this is very interesting. We are monitoring this. I mean, there is a big conference going on, I think, right now on tipping points, and I sent a staff member to attend. So we are clearly interested in this, but it seems to me that the science is not yet firm, and we should not rush it.
Livia, is there a scenario that you think applies or characterizes the current global response to climate change or
So is the question is your question about the most likely scenario, for example? So what I think is most likely to happen?
yes.
Probably is a bit what I also said before, that the so both in the short term scenarios and in the long term scenarios, we have this assumption of NDCs. So this is national determined contributions, which is what countries pledge to do in the context of the Paris process, and this is probably the baseline, and of course in the current in the current values. So these planned climate policies are very far from guaranteeing a net zero transition. So we are quite far. So we have to assume, if things don't change substantially, that we are deviating, in an important way from the net zero path. So that's unfortunately where we are now. The other, probably the other bit that I find also kind of believable, in particular in the long term scenarios, is what we call the fragmented world. So we have so one of the seven long term scenarios is one where certain areas do the transition and others not. And so you have this kind of deviation, the discrepancy for between different areas, and that is also a plausible outcome. Last thing I wanted to mention is we have worked a lot also with a consortium, with our consortium, to refine the estimates of the economic damage, and that is a very fast evolving science. So like 10 years ago, so we had relatively small numbers in mind, but now it seems that science is converging towards larger numbers. So we have updated those numbers. This is what is called the damage function, and so we have updated those numbers. I mean, we have sometimes been criticizing for doing it too quickly, but again, other users or other observers think that we are doing too little there. So we have received obviously feedback on both sides. But again, so we try to keep up with the science. And this is also, I also wanted to stress that this is a bit the DNA of our institution. So we are central banks mostly. So we are really used to be very analytical, cautious. So you will not see us jumping on a new theory easily. So we want to test things, be sure that the science is sound, is a bit what how we operate. So I know that sometimes it's frustrating because of course climate activists or other activists have certain stories in mind, but also users should understand that we should not jump on any kind of fancy theory, but we need to be very grounded in as much as possible in science.
Yeah, it's a hard balancing act to strike. And there's a lot of information on your website, both about your work and your approaches to climate risk assessment and the long term and short term scenarios. There's a lot of information that we didn't get to discuss today. Is there anything in particular that you want to point our listeners to on the website, which is ngfs.net?
I guess it depends on the purpose of listeners. So I mean, for those who want to know more in general about the short term scenarios, there is a lot of documents online, and even the slides that we published, the NGFS published for with the release are very informative. I think by now I'm sure there are also online videos presenting those. So for those who want a general, so becoming acquainted with this work, at relatively little cost, you can kind of derive probably useful information. What you probably for us is particularly interesting is those who actually use the scenarios. So at least maybe financial institutions, maybe authorities. So these, so we are particularly interested in that experience, and we try to collect feedback. And there is also on the YASA portal. So there is a link somewhere in our website. We also point to Q&A possibilities. So users struggle with something, they can email questions, and we have somebody in the team of modelers who are responding to these questions. So we are kind of always kind of interested in particular in that. And this I should have mentioned from the beginning. This really was the first version. It's really should be seen as a prototype. So we hope to learn from users, where it can be improved. There are certainly, so we know that we know already there are some aspects that could be improved. But for the next release, we hope to make significant and positive adjustments.
Great. So that's important to know. You're really looking for feedback from the users of the scenarios to help improve the process and the scenario outcomes over the long term, or as you continue to evolve the short term scenarios. Um, well, Livio, thank you so much for joining us today. It's been really a pleasure to have you as my guest, and I'm excited for the information and the work that you've done with the short term scenarios for that to kind of become part of the decision making for financial institutions and central banks.
No, thanks so much for inviting us. I mean, giving us this forum is important for us, and the more we can spread the word, the more feedback we elicit, the better. So it's also very useful for us, and also thanks for your questions. I mean, some of the questions are the same and whatever it is, but some are new. So today I received a couple of questions that I not received before. So already this is useful for us to absorb. So thanks so much for having us. So it was a real pleasure.